Okay, so good afternoon to everyone attending today. Pleased to welcome you to our next episode of our series, which is taking place over the whole of March, Themes for ISA in 2024. This week, I'm sure you're aware, we have provided a range of options for investors that are looking to gain exposure to the mega trends that are driving the global economy. And today, we're pleased to welcome Mike Seidenberg, who is the lead manager of the Allianz Technology Trust. As many of you, I'm sure, are aware, ATT focuses on offering an exposure to the core secular growth themes within the technology sector. But Mike tries to take a little bit more of a diversified approach, looking at those sort of derivative plays that he terms on some of these core themes. The trust is trading at an attractive discount of around 11% as of yesterday. And in our view, it seemingly is providing great value to gaining exposure to the sector. So Mike's here to provide an update for us on the portfolio and where the team is seeing these opportunities. And that'll take around half an hour. And hopefully we'll have plenty of questions to dig a little deeper into towards the end of the presentation. And I encourage everyone to use the Q&A function at the bottom of your chat screen there. So without further ado, I'll hand over to Mike. So yeah, take it away, Mike.
Great, thanks. And hopefully everyone can hear me and see the slides that we're going to go through. My name is Mike Seidenberg. I'm the lead portfolio manager of the Allianz Technology Trust. I've run the trust since July of 22. My predecessor, Walter Price and Hua Chen, were the portfolio managers for I think north of 15 years. So I inherited their due diligence and process around tech companies, and worked very closely on the product since I joined Allianz, which was in 2009. So been here for a while. We're actually now Voya. Voya was acquired. Voya acquired Allianz's U.S. assets, but we sub-advise to Allianz, which is why it's the Allianz Technology Trust. My background, as a point of reference, I actually came out of industry many moons ago, many decades ago. I worked for Oracle Corporation after attending Columbia Business School, did a variety of things for them, and then came to the buy side in 2001 and have worked on the buy side since. My background, as you probably just heard, kind of cut my teeth in software, in industry, but over time, not surprisingly, since it's such an interesting job, picked up a variety of new sectors. So this is where I sit today, and I really consider myself fortunate to have people like you, those of you on the call, as shareholders who really believe in what we do, and a lot of people have been, very long-term investors. So with that as a backdrop, we'll get started, and as we'll take Q&A at the end, and by all means, ask questions. I'm here to answer them. And I apologize if you can hear the garbage outside. Happens to be garbage collection early morning here in San Francisco. At any rate, let's get started. So one of our core tenets, or one of the ways we really think about the trust, is we think about technology in this kind of notion that technology is more of a winner's game than a loser's game. And what do I mean by that? I mean that if you think historically and go back and look at technology and where technology companies have garnered dollars from their customers, they tend to be areas that are literally almost birthed out of an existing budget. If I think about my own career, software, when I worked at Oracle, cybersecurity was embedded in the chief information officer's software budget. But today, that's a standalone budget. And that's a really good thing. And what that means, across technologies, as sectors emerge, those sectors have dollars available to spend. And that's why these companies have some of the growth profiles that they have. And it's kind of why we really think of it more of a winner's game than a loser's game. I think if you take a step back and just think how that may manifest itself, in our day-to-day lives, just think about your interaction with technology today versus your interaction with technology, 10 years ago. It's just such a different experience for not only businesses but consumers. And that's why that is part of the excitement of the sector. That's kind of why the sector is as large as it is, and why we continue to see really new and innovative companies and new and innovative themes. So that's what we mean by winner's game versus losers game. Excuse me. One of the things that we think is a real advantage for the trust is just being located in San Francisco. It's not as if other places don't have some advantages, but if you think about it, so many of the companies that we're tracking, that the themes that are emerging really start in the Bay Area, and then they obviously go to other places. But we think that that's an advantage in that, if I just think about my access to the companies that we invest in, it's very robust. And it's something that we try to really take advantage of, with respect to spending time with the companies we invest in, spending time with private companies, listening to them as to what they're doing and how they may impact a particular public company. We have a proven track record with multiple decades of experience. We have a very consistent yet evolving investment process, something that we really focused on, stock selection and risk management. And then, as I said earlier, just the proximity. So the team, and we do operate on a team approach. It's kind of fundamental to how we do things. The team collectively manages about $6.5 billion. And one of the things we really kind of focus on is we tend to focus on more of the mid to large cap companies, and try to be structurally underweight the mega caps. At times that can be something that is more beneficial. At times it can be challenging given the performance of the Magnificent Seven that we've seen as of late. But generally speaking, we have exposures to those companies, but we're going to be well underweight the benchmark, and they tend not to be kind of how we drive the bulk of our performance. The team, and this is the team, you can see me on the left-hand side, 5 individuals, lots of experience. We work extremely collaboratively. To give you some examples around that, I was just on a call earlier this morning. We have a call every day where we talk about what happened yesterday and what's happening this morning. This morning we were talking about the NVIDIA conference that's occurring right now. We were talking a little bit about Microsoft's new hires. They hired 2 key people around artificial intelligence, and that is a formal meeting that occurs 5 days a week. We have 2 meetings a week with the Allianz, with the technology franchise, and you'll see that later in the slides. But that's where we meet with our coworkers who run strategies like artificial intelligence, smart cities, space funds. That meeting occurred yesterday. It's very structured to the extent that there's a lot of talk about companies that we're looking at, and try to get lots of people's opinions on sectors and various companies. So we really believe that collaboration around investment decision-making process makes sense, understanding that ultimately every decision that's made in the trust, whether we are buying something or selling something, is made by me, the lead portfolio manager. So I'm ultimately accountable for everything, but work extremely collaboratively with the people on this slide. In fact, it's kind of like how I spend my day. Yesterday, John Coyle and I were talking actually to a UK company called Dark Trace, that we're looking at So, really focused on, I really work closely with every individual, really trying to understand, people's strengths and weaknesses, and how that may manifest itself as we go about making investment decisions, and really trying to figure out where the levels of conviction are amongst the team members. But I think that collaboration around investment ideas really results in better decision making than me kind of autocratically making a decision. So what's our philosophy? I think that one of the things we really focus on is just kind of boots on the ground, right? Just being able to go out and listen to, whether that's customers, whether that's chief security officers, chief information officers, really take in those inputs that allow us to really get to understanding kind of, where companies might be spending or not spending money on technology. And then obviously within this framework, we are looking to identify a secular themes, and if I told you I could identify 5 of them this year, you should probably, run as fast as you can from this webinar. But the reality is, it's a process that, when you do identify something secular, whether that's software as a service, whether that's movement to electronic vehicles, cybersecurity, when you do identify a secular theme, which is a difficult thing to do, you really want to figure out how to monetize that, because they don't come about that often. And when they do, they tend to take lots of dollars on the investment side within a company, and then companies spend against that. I mean, I'm sure if I say artificial intelligence on this call, everyone's eyes probably roll, but that's clearly a secular theme. I can recall last year, as we were doing work on it, which kind of gave us conviction, talking to a friend of mine who is the chief innovation officer at a large health maintenance organization, and really understanding how they were going to use artificial intelligence, whether that was on patient outcomes, delivery of services, in this case, healthcare, and just overall, better customer satisfaction. And he was very articulate with respect to the opportunity set within his organization. And we heard that type of messaging very consistently across all verticals, whether it was a healthcare company, whether it was a software company, whether it was an oil and gas company. And that kind of allowed us to identify a theme. So that's kind of, just kind of thinking about stock selection. That's one of the things we do, is really to try to identify these investment themes, and then obviously thinking about the risk aspect, right? One of our core tenets is really to focus on owning the market leaders, because we think that better management typically makes better decisions, and we want to mitigate blow up risk, which is a real risk in technology investing. And then the good thing is we are able to diversify the portfolio, because we can diversify it vis-a-vis subsectors. So we can own commodity semiconductor chips, we can own legacy software, we can own growth software. So we have diversification within technology, just given the fact that there's a lot of different subsectors. So this is our real kind of process, right? As I kind of alluded to, and I won't spend too much time, lots of listening, really, just to go out there and to listen to, customers, listen to people, listen to management, obviously, read sell side notes, but, really kind of take in all that information to create this investment mosaic. And that leads us to being able to identify attractive subsectors, and then attractive companies within those subsectors, really thinking about, what do the operating margins look like at scale? What are the barriers to entry in a given subsector? And then that allows us to create a portfolio which is diverse from a style perspective, but also diverse from a subsector perspective, and then understanding, how is that portfolio behaving. I receive daily risk management reports. We have a weekly meeting with one of our risk management people, and then we have quarterly reviews. So really thinking about what are some of the unintended consequences that we may have within the portfolio. From that becomes a portfolio of about 40 to 70 stocks, depending on the environment. And so, it is a portfolio that is benchmark aware, that's not benchmark driven, as you can see by the higher conviction with the lower number of stocks. Our benchmark is the Dow Jones World Tech Index, which does have some chunky positions in the mega caps. We tend to be very active. We tend to have a higher active share than a lot of portfolio managers. And the portfolio turnover tends to be, I think last year it was 75%, which is down from my predecessor. But, we really think in terms of we want to mitigate our mistakes. So therefore, given the rate of change in technology, there are times where we're wrong. Definitely times where we're wrong, and we have to sell the stock. So that results in a little higher turnover. Look, we typically look for companies above the above the $2 billion threshold, and max position, tends to be around 10%, although we have gone higher if it's based on appreciation. I will note that we have a really active board here, which I think is a great thing, in that they really don't want too much risk in a single stock position. So even though the benchmark may be 15% in a company like Apple, we would never own 15% of Apple, even if we loved it. I just don't believe fundamentally in that type of single stock risk. So, on a daily basis, as I alluded to earlier, we're in very constant contact with management. A lot of my day is spent talking to management teams, either, about their business or about their future. We try to go meet with the companies face to face, at least a couple of times a year, whether that's, going to their headquarters or whether that's seeing them at a conference. And then we really want to understand, the competitive landscape. I think it's so important in technology to create that mosaic that includes both public and private companies, because a lot of times the company that you're most worried about isn't the one that's that's publicly traded. It's actually an emerging company that I think of it kind of like as how a shark attacks people, right? They tend to attack from below. That's something that I remind myself as a public market investor, that a lot of times the company that is most threatening to our existing holding is something that may not even be, that typically isn't publicly traded. It's a private company that is emerging. So really wanting to create that mosaic so we can really understand what that landscape looks like. So the interesting thing about technology today, given the breadth and the size of the industry, is there's this technology life cycle, right? And you have companies go through very distinct phases of the life cycle, which affords us the ability to invest in those companies depending on the life cycle or depending on our view of them. So you have high growth companies, innovative companies, typically growing pretty rapidly. They may be losing money because they're spending money in sales and distribution. They tend to be hiring lots of people. And that's something that, that's a certain sector. And I kind of think of this slide as kind of a three-tiered cake, right? And these tiers, and this three-tiered cake allows us to create a portfolio that's diverse from a style perspective, right? So we have high growth companies, we have GARPy companies, these companies further on in their maturation process, not growing as fast, tend to be more profitable, and may have just better cash flow characteristics because they're at scale. And then we also have these kind of attractively valued companies with optionality, right? These could be a legacy company. I think a good example that you've probably heard about this past 6 months is Oracle Corporation, right? excuse me, it is a mature company. They're having a product cycle around artificial intelligence. They're executing across that product cycle well. And if we invested in Oracle, we probably wouldn't be under the notion that we think the stock could go up 3x from here, right? We'd probably say, look, we think the stock could go up, it could be 30% based upon this product cycle. But what the slide should hopefully, show you as investors is this just shows you the diversity that that is occurring today within technology, because the sector is large enough that it affords us lots of different buckets to put companies in, and that goes back to this notion of really kind of having a diverse portfolio, a portfolio that isn't too dependent on a certain type of company or a certain style of company. The other thing that's interesting from our perspective, and I can talk about it later on, is I have some examples where we've been able to monetize every aspect, whether the company was in high growth, whether the company was in in a GARPy position, or whether it was kind of a value-based company. So that's interesting as an investor, given that I have a lot of different companies in different phases of their maturation, and that may allow me to own them depending on what I'm looking for in the portfolio, what the team is looking for in the portfolio. So this slide is just kind of showing us the relative PE ratios of tech companies, and we go back to 98, and I apologize, we need to add 24 to this. This just shows us the end of 23, but we need to roll it forward a little bit. It just kind of shows you that tech traditionally trades at a premium to the overall S&P 500. That makes sense to me. Like if I think about competitive advantages and what companies garner from investing in technology, I think that it makes sense if I think about the growth rate of tech companies versus the average market, and also why investors may put a premium on tech companies. This slide totally makes sense to me, but I want to just show you, there are times where that spread is narrow, and there are times where that spread is wide. And I lived through the .com days back in 99, 2000. That didn't make sense to me. I didn't understand why it made sense to, just because you had an internet browser, why you'd ship a brick across the country. That just doesn't make sense to me. But I definitely think in terms of technology companies relative to the S&P from a valuation perspective, and kind of what the relative premium is over time. I think that one of the things we experienced, which wasn't particularly a fun thing to experience in 2022, was just this kind of you saw software valuations really dramatically decline as we exited the pandemic, as companies digested just all the software they had bought. And if you take a look at kind of where we are, where we are today, the valuations have come down. They're not as high as they were. I actually think that they're actually pretty reasonable from a relative perspective. And here again, this slide's a little out of date, and we'll get it updated. I think we need to update it, but it was about 5.5 times as of mid-November. That to me is a pretty fair valuation for a software company. One of the things that jumped out at me, if you go back historically, if you go back to kind of 2017-ish type of rates, we're trading at a discount to 2017. If I just think about the relevancy of a software company today and where we are in 2024 versus 2017, and just the dependence that customers have on software, that doesn't make a ton of sense to me. I think software companies probably deserve a higher valuation. I also tell you that we're not underwriting the portfolio expecting any of our names go back to that kind of pandemic peak that we saw in 2020 of kind of a 20 times multiple. I don't think we'll get there. I'm not underwriting anything in the portfolio at that type of valuation, but we are seeing really interesting opportunities as a team across a sector like software. And as you can imagine, with my background, I spend a fair amount of time, kind of fishing in this pond. So, I think that one of the drivers that we're seeing in the business is just this notion of just how connected people are, right? I mean, if you think about your own personal experience, whether you're at a work on a desktop, mobile, now you're seeing, a lot of autonomous driving. You're seeing factories are connected. So this notion of digital networks going everywhere, and we're just uber connected as a society, and that's not just people, right? It's it can be a street light as to how it turns on and off throughout a given year. So there are all these digital networks, and that requires lots of spend. And as they spend, they obviously they buy from the companies we invest in. I just thought this was a pretty interesting picture, just to kind of help you think about it. So within the trust, as I alluded to earlier, we try to identify secular themes, some of which are represented on the right-hand side of this slide, and to try to figure out companies that have exposure to multiple secular themes. And this just kind of shows you the portfolio, and kind of some of the exposures that we have in it, to the various themes that exist today in technology. Some of these themes we're more excited about, and some of them we're less excited about. I think the point here is there are a variety of things occurring, and we have the opportunity to really be able to monetize that, vis-a-vis investing in them. This just shows us, I'm sure you've heard a lot about the cloud, and you probably say to yourself, wow, it must be over. I mean, this just shows us it's still early days, right? I mean, by 2030, only 45% of the enterprise IT stack will be in the cloud. And it's just such a powerful theme for companies that move there. You're basically taking a fixed cost, converting it to a variable cost. You negate technology risk because you're dependent on a cloud provider whose job it is to innovate, and you could be much more responsive. I heard a great example of a company. There's a bank here, I think it's in the UK as well, I've seen them in London, called Wells Fargo, and one of their competitors had a much more nimble infrastructure, and it allowed them to create products, right? Loans that you and I may buy as consumers. And basically what Wells Fargo realized was their legacy infrastructure, by the time they rolled out a product to compete against against this more nimble bank, the product was, the other company had already moved on and created something else. So you can see why companies really want to move that infrastructure, in order to be more responsive to the competitive environment. And I think that just continues. We did see a pause in cloud spending coming out of the pandemic. Things look a lot healthier right now, and that's something we're definitely excited about. You all heard about AI. I just thought that some of these quotes were really, you see a person like Bill Gates who says very few things. He's not a person who's in the press a lot, but he basically thought that, the development of AI was similar to the internet and the mobile phone. And we've seen that, and we're seeing that. And look, there are a lot of companies that are benefiting that shouldn't be benefiting, but there are definitely companies that are benefiting that deserve to be benefiting. And our job is to figure out, what's real and what's kind of fluff. But I do think that the emergence of artificial intelligence, and generative AI is something that is going to forever change, both, personal lives as well as businesses. So, this just kind of shows you kind of where we are on that on that journey of artificial intelligence. And I think that we'll all be pretty amazed over the next kind of 10 to 20 years just how autonomous things will get. We're still a long way from that today, but I was reading yesterday about NVIDIA and the amount of the performance enhancements that they were getting from one generation to the next. It's just mind-boggling how much more powerful their chips are and how much faster they are, and that'll just lead to better outcomes with respect to looking at the data that kind of drives artificial intelligence. Cybersecurity, arguably, the best. I jokingly say that, I will be long gone, and whoever replaces me, whatever, 20 years from now, 15 years from now, cybersecurity will still be around. It's just, part of having our lives be digital means we're more exposed. So, on the one hand, it's a positive as a consumer or as a business. On the other hand, there are risks associated with that, and those risks are, very sophisticated adversaries, in many cases nation states, who really are focused on getting people's info, holding companies hostage vis-a-vis financial, from a financial perspective. So the cybersecurity market is expected to grow 12.6% until 2030, and I think that's a solid number, and that means that companies are going to continue to spend aggressively in cybersecurity, and we've seen that as these companies continue to grow. The interesting thing is, from a technology perspective, you really need to have a layered approach to security, right? You can't just put all your eggs in one basket, and that creates lots of areas of spend that are very specific around cybersecurity. It's also worth noting we run a cybersecurity fund in Japan, a little north of $3.5 billion. So we spend a lot of time in cybersecurity, and we use a lot of those. Since we're a team, a lot of those ideas show up in the Allianz Technology Trust around cybersecurity. I work on a lot of those as well. EVs, I think that electronic vehicles, which currently are just, by the way, I'd tell you, currently our exposure to EVs is almost zero, just given there's a little bit of an air pocket. But if you think about just, the continued content of semiconductors, it needs to go in electronic vehicles as they become more and more dependent on technology. That's a pretty interesting theme. Obviously, there's a company called Tesla that's really put itself on the map with respect to electronic vehicles. I think, and I can allude to why we really don't have a lot of exposure right now, but it's something, I keep in the back of my mind that this is a sector I like, and at some point, once they get through this kind of trickier spot with higher interest rates, I think that you'll see people continue to buy hybrid cars and electronic cars. So data, I know, everyone on this call knows just how much data is out there. It is just every company wants to better understand their customer, wants to basically correlate disparate types of data, and that's a really good thing. For technology companies, in that there are lots of companies that really are focused on basically giving companies the information that they can get from looking at all this data. I'll also tell you that the data aspect is pretty amazing. Some of the stuff that companies are basically using it. I heard an example the other day of some car data being looked at by insurance companies to figure out, what exactly do the risk profiles look like in an aggregate perspective of various demographics. So, companies are increasingly using this data to basically optimize their business models. So I can just go through the trust really quickly, and then we can get to Q&A. This just kind of shows you how the trust is done historically versus the benchmark versus the FTSE. It's not something we spend a lot of time focused on. Obviously, our goal is to outperform for you. When we do outperform, we're not the type of team to do a victory dance. And when we do underperform, which happens at periods, we really want to figure out how we outperform again. So, but from a long-term perspective, the trust has created value vis-a-vis relative to our benchmark. At times, we've created more and less value depending on a certain time frame in the market, but we're really focused on performance and making sure we deliver to you, our shareholders. shows you just kind of some of the various weights of the trust and kind of where things sit. We've had an overexposure currently. We're overexposed to semiconductors and software. And as you can see, we're underexposed to hardware. Obviously, Apple being a big portion of that 17.2% benchmark. This just kind of shows you where the companies are domiciled on the right-hand side. What it doesn't show you is kind of where the revenues flow, and that would look very different, since almost every single company we invest in has a large international component to their revenues. And these are the top 10 stocks currently in the portfolio that we own today in the respective weights. As I alluded to earlier, if you leave this call with kind of a couple of takeaways versus maybe some of our peers, really focused on, mid cap and large cap companies, less focus on the mega caps, really trying to understand and identify these companies that we think can kind of grow into, make that transition from mid cap to large cap. Therefore, that's why our process is so important to really identify kind of where spend is going, and really be almost, pretty much structurally underweight the mega caps. I'll pause there. Actually, I'll stop there so you can see me. I don't know if you can see me or not. I'll stop sharing. Is that what I should? Yeah, stop sharing. Is that right?
Okay, thanks, Mike. Thank you for the overview of the trust. Very informative as usual. We have had a couple of questions come through. So the first one is a little bit on the sector and I suppose the allocation to secular growth themes.
Yeah.
Could you explain one of the smaller positions in terms of the 1.3% allocation to renewables, new energy, decarbonisation, etc.? It's the lowest allocation you have in those growth themes. So could you just explain that a little bit more?
Yeah, it's a great question. So as I think about technology and decarbonization and renewables, it's not an area where we spend a lot of time, given that my understanding of the renewables is pretty good, but we saw that if you go back and just think about the solar space and how incredibly difficult that was for investors, that space on the renewable side at times has really been dominated by China, and it really became commodity pricing. So it's not as if we wouldn't look at renewables. It's just not something that's really boiled up to the top within our fund to date. At one point, we, if you roll the clock back, probably I would say 12 years, we did have a decent exposure to the solar companies. And I've looked at some of the renewables companies. It's been a difficult space to really make money in consistently. That doesn't mean we won't get there at some point, but it just hasn't been a high area of focus for us.
Do you think that's something to do, I suppose, as new regulations coming through the ESG, et cetera, et cetera? Do you think that bubble slightly burst as well, a little bit?
Well, I mean, I think that, and obviously we are a very ESG aware fund. We're not mandated on it, but look, I think some investors have looked at the ESG driven funds and have probably not been overly happy with the returns. I don't really know why it hasn't been better, but and here again, let me be really clear. I think about ESG all the time. I'm constantly thinking about when I meet with a company, what does their share class look like? What does the board look like? Are they a polluter? Are they not a polluter? It just hasn't been. It just hasn't been, because it's not a mandate for us. We're not mandated on it. It's a part of our process and it's a constituent, but I don't know why those funds haven't done better, to be honest with you.
Mm-hmm. Yeah, it's a tough one. Obviously the Magnificent Seven have done pretty well this year, and you're probably bored of questions around them. But how much of a part do you think they're going to have to play moving forward in the development of some of these core themes that you're looking at?
Well, I think in some themes, the Magnificent Seven are clear leaders. Look, I think overall, and let me be really clear, I don't dislike the Magnificent Seven by any means. It's just that they seem fairly valued to me, and it's hard for me to imagine, Apple re-rating from here. They've done an amazing job of transitioning their business uh, from much more services, less dependence on hardware. But I think a lot of that's reflected in the multiple. I think that look, I think of the Magnificent Seven. Some of them are, some of them I'm a bigger fan than others. But I mean, I think universally, I mean, most of them. Face probably increasingly louder regulatory headwinds. And it's just hard for me to imagine the multiples expanding from here. It's not as if they're not good/great companies in many cases. It's just that the valuation seems fairly valued, and you're correct. They had a slight pause in Q4 of last year, and then they've kind of worked their way back into things this year. So very cognizant of them, cognizant that we need to run faster in order to outperform, but also not willing to kind of stake our claim in the trust or around even just getting the benchmark weights for some of them just isn't possible from a risk perspective.
Mm-hmm. Looking at some of the bigger positions in ATT. So Nvidia obviously is there at 9%.
Yep.
And I think you mentioned there's that 10% threshold that you're not comfortable going beyond.
Well, I would say this, Nicholas, the 10% threshold is so we started talking, and by the way, the Nvidia position got there. We started buying it aggressively more than a year ago. So it really got there on a lot of it's on appreciation. What we do is as a position gets above 8%, we start to have a dialogue. I start to have a dialogue with the board. I had a board meeting 2 weeks ago. We talked about Nvidia, which at that time was right around 10%. I said, look, I think that I think the right thing to do here is every 100 basis points, we check in. I'll check in with the board. Knowing that there's a threshold on the upper bound that probably I wouldn't want it to go above, but it's a very here again I go back to the fact that this is a board that's very active and really looks out for the shareholders. So they agreed. So we would check in if it gets towards 11%, which it isn't today. That we would have a check in and we discuss it as an organization as to what we were thinking.
Mm-hmm. Do you think that, not wanting to stick on Nvidia, but do you think that as an individual holding has long runway for growth still?
Sorry, can you repeat?
How long do you think that runway for growth is still with the stock? Do you think it would be better placed top slicing, which I presume you already have started doing already in some instances, but top slicing.
Yeah, I mean, they are such a dominant supplier today, and the lead is pretty amazing. I think that you've seen in the past 18 months fits and starts around the business. But I remind myself, they are the best supplier of something, i.e., artificial intelligence or generative AI, that every business or every organ, not just businesses, governments, research institutions, everybody is looking at it. So I think it's going to zig and zag. From a multiple perspective, it's not a particularly expensive stock. I think that the challenge is, can they maintain their margins? And I think that's something people are worried about. And can they continue to grow? They're supply constrained today. There could be an air pocket between the current chip and the one they just announced. That sounds amazing. But I think they're going to remain a really relevant company.
Mm-hmm. Sure. Where do you think, sticking to themes, I suppose, as well, again, where do you think the next big theme will come from? trying to talk outside of AI. I know it was still
Sure.
early days and things like that, and you've got your cybersecurity.
Yeah, I mean, I just go back to, and it's a hard question, and I wish I knew. And
It
if I
is. It is.
knew, if if I knew, I may not be uh, talking to you today because I'd be
Yeah, absolutely. Yeah.
well ahead. Look, I think what is obvious, or what remains pretty obvious to me, is just the power of software and what it means to businesses. And that's something that I don't, if you go back historically and you just think about whether it was the introduction of, Microsoft Office back in the day, or even, half the people on this call won't even know, but there was a company called Lotus 123 that I actually used in college, which it doesn't make me feel young. But it's big area of spend, or where's the continued spend. We spend time, we spend a lot of time in semiconductors, right? If you think about just power man, all the things that go with these massive data centers, whether that's power management around it, whether that's communications equipment. So one of the things we do, and it's an important takeaway that I wanted the people on the call to understand, is we really think in terms of investing in an idea and then thinking about the first and second derivatives, right? So I'll give you an example. We invested in Nintendo when we figured out the Wii, but we also figured out who built the controller in the Wii, in the handheld device that controlled the Wii gaming platform. And by the way, we made a lot more money investing in the controller company than we did in Nintendo. So really thinking, one of the things that the team and I really spend time on is really thinking about what are first and second derivatives, right? It's not just, so if you think about artificial intelligence, right, break it down into suppliers, enablers, right? Who are the suppliers on the supply side, and what companies are using artificial intelligence, if in the example that we're talking about, as enabling their businesses, right? As who's using that technology to give their customers the best product, and trying to identify those companies and investing in those companies. Because I think that one of the things I've noticed over 20 plus years of investing is, a lot of times, if you think about just the supply chain, if you think about first and second derivatives, that there are just lots of opportunities. There are lots of beneficiaries of that secular theme.
Mm-hmm. Mm-hmm. We have had a question about whether you are personally invested in the trust.
Whether I'm personally invested in the trust?
Yeah, or in a similar kind of strategy and the companies you're looking at. I assume.
Absolutely. That's a great question. So, and it's something we're working on. I am precluded, because I'm a Voya employee right now, of investing in the trust. It is something that and let me be really clear. I definitely want to be invested in this trust. I want part of my compensation plan to be related to the trust. So I apologize, I'm not right now, but if I could be, I would be, as an employee. And in fact, we were just talking about it yesterday as a team, that we all in Voya is working on it. So I'm not trying to kind of kick the can down the road, but the day I can be, I really think part of my compensation plan should be related to being invested in the trust.
I suppose a question about explaining a bit more about the fair value, I think, regarding some of the holdings.
Sure.
And how a 5 times multiple sort of can be fair on the value of the stock, I suppose.
I mean, 5 times. Well, I mean, 5 times. I mean, 5 times. Look, 5 times you'd want to buy a lot of companies all day long in software. I mean, if you think about private equity, typically the private equity floor tends to be kind of 5 to 7 times, where they can make the math work. Really, they can make the math work on acquiring it. Look, ultimately, every company, and it's worth noting, if I didn't make it clear, I apologize. We use a variety of different multiple of valuation metrics. One of the valuation metrics for five, in the software example, what you're asking about is, remember, many of these companies, they are, the subscription model really penalizes, from an income statement perspective. You recognize a sliver of that revenue, yet you incur all the costs, right? Which is why many of these companies in software, as they grow, go from being, negative, losing money, to then having good cash flows as they mature. Traditionally, so why 5 times? Because most financial metrics allow you at 5 times an EV to sales in order 5 times EV to sales to basically create enough cash flow to actually service the debt. And that's what, so we use it as a floor, because the private equity companies tend to get really excited about companies at that multiple.
Mhm.
And by the way, there's probably no right or wrong answer here, but it's part of a framework. I mean, I would also look, on a more mature company, I would probably look at, free cash flow generation and growth. We here again, we use a variety of valuation metrics. It just so happens that the slide that I showed, just kind of, a lot of investors tend to look at software companies on an EV to sales basis, knowing that software in general has good operating margins at scale. So you kind of use an EV to sales basis when companies are a little bit younger.
Mhm. I suppose, looking at the composition of the portfolio at the moment, do you see a time I suppose over the next year or so, where you look to dial back the growth exposure in the portfolio? I know it's a technology-focused trust, so you're looking at growth predominantly, but when
Sure.
you're looking at that, looking more.
Yeah, no, depending on the markets, we've had higher exposure to lower growth companies. I'd say right now, it's not overly growthy historically for the trust. I mean, as you can see by our large weight in semiconductors, which tend to be less growthy than some of the software companies. I think one of the things that we're trying to do is trying to identify, new investment opportunities outside of both those sectors, so we can kind of put some money into work. I mean, I'm not, if I thought we were going into a pretty tough economy, I may not have as much growth exposure, but generally speaking, like, I actually feel pretty good about IT budgets this year compared to last year. And I feel like we're in a more predictable interest rate environment. And therefore companies can probably, remember, companies have probably underspent around technology the past 2 years. And they probably need to play catch up, because all of us on this call, our needs from our IT departments, continue to kind of drive forward. I mean, the answer is, I don't really know, but some of it's just dependent on, we tend to be bottoms up investors. So I don't think of it as, I want to have this much growth. What I think about it is, who are companies that I think can appreciate and have good risk reward for our shareholders.
Mhm. We've had a question of themes again, I suppose, but have you thought about looking into more biotech side of things?
It's a great question. We do not do biotech, primarily because I think that I'm at a disadvantage compared to my peers. I think to do biotech effectively, you really need to dedicate resources that have, strong science backgrounds. And it's just not something the team. It's, if I think about and we actually have a biotech fund, at the firm. Their backgrounds as investors are very different than my background. The person that runs it is an MD, although I don't know if he ever practiced. So as much as I came out of technology and kind of am very comfortable in technology, he understands the sciences of biotech. So I feel like even if I focused on it and could learn kind of how the companies behave, I feel like I'd probably be at somewhat of a disadvantage there.
Mhm. I suppose, do you have any comments on the discount, Mike? I mean, for us, it's obviously flashing,
Yeah,
great
the
value at
only
the moment.
comment and I apologize. The person who handles distribution isn't on the call, but the board is very aware of it. They've been in the market buying back shares. It's something we'd like to close. Obviously, from my perspective, like to, I wouldn't want it to be at a discount at all. We're trying our best, working on it. Not that this is no excuses, but relative to some of our other peers in the technology sector, it's not nearly as wide. Look, I'm not making an excuse, but the board is aware. We're active. We're trying to be active around buybacks to minimize it.
Okay. I think it's a natural function of a bit of investor sentiment as well. Has to creep in and a bit more comfortable.
Yeah, but the interesting thing is, even last year as things turned, most of these tech trusts traded at discounts. Even as I mean, if you think about the performance of technology last year, it surprises me a little that the discounts weren't narrower.
Mm-hmm. Mm-hmm.
It was a good neighborhood to be in.
Yeah. I think we'll be wrapping up shortly. Just looking at the time, I've got a final couple of questions to go through. Looking at 2021 and 22, when interest rates were rising, and it looked probable that technology companies were kind of overvalued. Do you have the ability to take out derivative insurance to protect against a bit of a bubble in the market at all?
It's a great question. We do not use derivatives. The way we could, basically, what we did, and we didn't do enough of it, is we shifted the portfolio more towards value stocks, and we didn't have enough of them, and it was painful. But no, we do not use derivatives.
Keep it quite clean, and I suppose that's similar to the gearing, take on gearing as well.
100%.
Yeah.
We've never used it.
Yeah. Okay. Maybe a final with the US election coming up towards the end of the year. Do you think that'll have any impact on the portfolio at all? Maybe
I
a bit of an open-ended question, but
well, no, it's a totally fair question. Look, I think that what I've seen on multiple election cycles, it usually has about a day or two impact, and then people kind of get back. I can remember when Donald Trump was elected. I believe technology stocks had just a terrible day 2 days after he was elected, and then they all came. They started to things kind of got back to fundamental orientation. So look, the honest answer is there'll be some impact regardless of who is elected. Our job is to try to find companies that aren't I mean, the wild card with Trump is that, depending on the day, he usually goes after a company. And that can, we were talking about the other day, last week, I think he hated TikTok, then he liked TikTok. I mean, he's a somewhat of an unpredictable person. So, he tends to be kind of in the long run. And I'm not trying to skirt the question. In the long run, it ends up being kind of noise. But in the short run, on a given day, if he calls out, whatever, he hates Nike and he thinks Nike shoes he just has such a vocal, I'm trying to be as polite as possible. He's such a vocal person about things relative to a lot of other presidents.
Sticking to the fundamentals of the portfolio, then I think that's
what we do. I mean, obviously the macro matters, right? I mean, I often say we're bottoms up investors with a macro overview, and the macro matters, right? I'm not going to, as much as everybody on this call could say, hey, Mike, we really care about your numbers in 5 years. The reality is people care about the numbers in 5 years, but they also care about the number a year from now.
Yeah, for sure. Is there anything you want to summarize with, Mike, there?
No, I just appreciate the time, appreciate the support. I've probably met some of you throughout my travels, and hope to do so, going forward. And, I think that probably similar to some of my peers, I just think technology is such an important sector. such a dominant sector for first world countries like ours and like the UK, that it probably warrants exposure in your clients' portfolios in some way, shape, or form. So
Yeah, I'll agree for sure. Okay, well, I think we'll leave it there then, given the time.
great.
So,
Well, appreciate it, and we'll be in touch. And enjoy your evening.
will do. Thank you very much, Mike,
Okay.
and thank you all
Yeah.
for joining the
Okay, see ya.
presentation, and enjoy the rest of your day. Thank you very much. Cheers, Mike. Bye now.